We're snorting cap rates and shooting up cash flow here at Deal Junkies.
Welcome back to Deal Junkies. We're here without Gabe, without Dane. It's just me and Mike. So we're going to talk economics and maybe some midterm rentals, but Mike's going to give us an economics lesson because we're filming this on, what is it, August 1st, 2nd, something like that?
Yeah, the big day, the big event happened.
Mm-hmm. And the 10-year treasury just dropped drastically to what?
It broke under 4.
Broke under 4, and I don't know a ton about it, so I'm going to learn a little bit here and ask Mike a bunch of questions, but I'll let you kick off on what's happening right now.
Yeah, good question. So essentially we've had a money allocation event. And when I look at economics, that's all I really look at is the 10-year. Because it's just most applicable to me because it correlates to interest rates, but more it's if you understand the bond market and you see the trends and the patterns that are happening in the bond market, which are sometimes inverse of what's happening in the stock market, then you look at what's happening from a money market savings, cash on the sidelines, gold, Bitcoin. You see where these pools of capital are. And so you kind of look at, well, you have 3 buckets. You have the equity markets. You have the which is the stock markets. You have the bond markets, which are the, what are they? My brain's kind of shot right now, which is the income markets, the debt markets. And then you have cash, which is then the assets that are hiding on the sidelines and in cash. And when you have big moves in monetary policy or big changes in investor sentiment, money gets reallocated from those buckets on a macro level. And what happened today is the jobs report came out really, really weak, a couple days after the Fed committee meeting, and the statement essentially from the Fed committee meeting is they're going to cut in September. So you have all this momentum saying, okay, the Fed's finally here. And what happened on Wednesday after the comments was all the markets went up. So money got poured into the bond market. So bond yields went down because values went up. Money got poured into the equities market. So the stock market went up. And so you saw like the best of both worlds. Everyone's happy. And what that was now money, cash coming off the sideline going into both of those markets.
So how is the Fed cutting interest rates directly related to bonds?
It's because the Fed leads the way with policy, and investments are all based on policy because the policy is going to affect the risk-free rate. So at the end of the day, everything comes down to the yield curve. That's why the yield curve is so important. And then the allocation of money is based on that risk-free rate.
So is the yield curve looking at the bond market and the 10-year treasury, correct?
Yeah,
and
exactly.
It's looking at it versus 2-year versus 5-year or whatever.
Yep. Yeah, so you get your 1-year, 2-year, 7-year, 10-year, 30-year. And you want the lower rates in the front, and then they get higher as you go out longer that's the typical yield curve.
Yeah, so you're tying your money up for a longer period of time, so it pays you higher return is the idea. And then
Yes.
when it inverses, those things flip.
Yes, correct.
But how does the Fed cutting rates actually affect the bond market there? Like, how do those things intertwine? Like, what money is this that the Fed has versus what money is this that's in the bond market?
So when the Fed increases or lowers their rate, what they're doing is they're increasing or lowering the rate for other banks.
And that's their overnight rate, and that's what they're
Correct.
lending money.
Yeah, the way I kind of think of it, and this is just, I'm not saying this is right, but this is the way I think about it to make my mind see the patterns and understand how the machine gets put together. So the overnight rate is essentially how banks level out money every night, how they transact the day, right? So based on reserves, they have to have a certain amount of reserves at the Fed, but every day banks have money going out, money coming in. Some banks have more money going out than money coming in, and vice versa. And so that's where the Fed operations happen then, is to level out and ensure at the end of the day, there's either loans to the banks that are not enough money or too much money going out than coming in, and vice versa. And so that's where they charge that rate.
Yeah. So the idea is it's a banking system, right? And these
Yes.
guys are all borrowing from each other. If they have more money out than coming in, then they're borrowing from another bank at this overnight rate.
Correct. Yeah, exactly. Right. And so then that sets the low end of the yield curve. So that should affect the 1 year, and then the 1 year, the 2 year, and it stacks upon that.
Okay, so the Fed sets the overnight rate
Mhm.
of what these banks are borrowing from between each other and from the Fed, correct? Are they borrowing from the Fed as well?
Yeah, that's exactly right. And so based on their deposits. So if they don't have enough deposits because they had too much activity, they're borrowing from the Fed. And then vice versa.
At that
Fed is
overnight rate.
Exactly. Correct.
And then how does that overnight, that you're saying the overnight rate is the federal funds rate. You're
Mhm.
saying those are interchangeable, right?
Mhm.
Okay, so how does that affect the 10-year treasury? Because the 10-year treasury is not the same thing, correct, as the overnight rate?
Yeah. Yeah. So think of the overnight rate is it's the basis on which the monetary policy is set on. So it's not just, hey, this is the yield curve. It's the very front end of the yield curve. So it does have an influence on it. But it's what it's saying is this is the policy direction we're going. And so this is what we can expect. And so if we have a sustained period of time where increasing rates, we're too hot, we need to slow it down. And then so when the Fed cuts, everyone uses the word pivot, for example, right? We think of a pivot is a 180. That's what like the trend, the media thinks of a pivot is. Well, that's not how the Fed works, right? So we think, okay, well, in March 2022, they started increasing rates. And so then the pivot is them declining rates. But there's all these little instances in between. But that's not how media works. That's not how markets work. That's not how emotions work. And so what was so big about Wednesday was essentially they're saying, yes, we are going to cut rates. So now we have pivoted. So all those little steps in between are now here and in the moment. And now we know policy direction is shifting. And so policy direction shifting then tells the cash on the sidelines time to reallocate. And if you think about it, is money was sucked out of the bond market, and early on after 2022, stock market went down as well, right? So money was sucked out of the bond market and out of the stock market and then went to the sidelines. And then we had that period of time, we had a bunch of tech layoffs in 2023 to start off 2023. Then money, because the jobs report was pretty strong and because inflation was coming down, we had money coming off the sidelines, but it wasn't getting allocated to bonds. It wasn't getting allocated to lending because we still had an inflationary environment. It got allocated to equities. It got allocated to the stock market. Does that make sense?
Kind of.
How allocation moves around?
Yeah, I'm still trying to understand the correlation still. So investors see the 10-year treasury, they see what the Fed's doing, and then they either buy, sell bonds, move their bonds around, depending on what they're seeing the overnight rate doing. And those are correlated because of that?
No. So I think that's the biggest misnomer. I don't think the markets really move on the overnight rate. I think they move on policy direction, and the overnight rate is like the litmus, the defining moment on policy direction. Does that make sense?
Mm-hmm.
And so, and if we kind of go back to the yield curve for a second, so the yield curve is the reflection of the investor sentiment on the economy.
Yeah, so all the yield curve is showing the current interest rate it would pay you if you bought a bond. Yep. And I was reading that bond book we were talking about. So every bond is sold for $1,000, right? That's like the stable price point of a bond.
The coupon, yeah.
Yeah, the coupon, yeah. And then the coupon price does not change, but the rate changes, correct?
No, the coupon rate doesn't change.
But the price changes.
The price changes, which changes the yield.
Okay.
So and this is a great place to start. So the bond comes from the Treasury, right? So Treasury notes get packaged and then sold as a bond. So you have notes, coupons, bonds, right? And those words are just based on their time frame. So like notes are short-term time frame, and the bonds are long-term. So they're just words. But all
is
of
there an actual time frame there? Because like
so
is
they
a note
get
a 2-year bond?
So they call it like the quarterly funding, right? So the quarterly, the government goes to a funding and they say, okay, we need this much funding. That means we're going to issue this amount of debt. That's how they fund the government, right? So, and then they issue the debt on those different on the different parts of the curve based on a lot of things. What do they need the money for? Where is the market? And the SOM rule, like I want to talk about the SOM rule because that's something that came out. And one thing so she created it, I think during COVID, but it's like the idea there is to get fiscal policy in line with monetary policy. So that comes now issuing your debt. Where are you issuing your debt based on where is the yield curve? Where is investor demand, right? So if you think about it this way, if you're going to issue a coupon at 4%, you want a 4% rate. As the government, you want people that will pay more than $1 for that 4% rate. Does that make sense?
You're saying they're collecting a spread on it.
Exactly. So if they pay a dollar one, they actually make more than $1 per dollar on that issuance.
You're saying by selling that bond?
Exactly.
Like,
so they issue it to the bond market, and then the bond market bids on it, and then they buy that debt. And so the way that inflation works and the way that money gets pumped in the economy ultimately is the government has a spending package. They create these bonds. They take it to the bond market. The bond market buys it. So in that event, they take money out of the economy. Okay? So the bond sale...
Okay, wait. Let me back up so make sure I follow it.
Yeah.
Okay, so government issues debt. That's these bonds.
Yep.
It's the promise to pay. It's super secure, so people like it because it's safe debt. They're pretty much guaranteed based on the U.S. government. So they issue this debt. Someone buys it because they want to collect monthly payments on this and collect their dividend that's super safe.
Yep.
And then they're retrading later on. So you're saying the bond, repeat that part, it goes to the bond market. They issue it goes to bond market.
So think of it this way. So the bond market is just investment capital, right? It's investment capital out there to buy investments.
Okay.
So
is that who? That's me and you? We can go buy these, or it's large
anybody
companies?
can. Typically, so the movement in the bond market comes from the huge funds, the pension funds, the insurance companies. That's
so
where
they have your 401k money all pooled together so they can make large movements.
Yeah.
Okay.
But you as an individual can also go buy these as well.
Okay.
But the movement comes from macro money. And so there's macro money out there, investment capital just ready to go. The government says, okay, it's quarterly funding time. We need this amount of money. We're going to take it to the market, and we're going to take it in these years, the 1 year, the 2 year, the 7 or the 10, whatever.
Meaning they'll pay it out.
Exactly. We're going to issue a
payout,
10-year note. Here's a bond of 10-year notes, or here's a bond of 1-year notes.
Mm-hmm.
And then what happens is when they issue it to the bond market, they suck investment capital out of the economy, right? Because that investment capital can go anywhere. It can go to equities. It can go to bonds. It can go to cash.
Okay, so they issue more bonds. More people buy bonds.
Yep.
Meaning they're not spending the money elsewhere.
Exactly.
Okay.
Correct.
And
so
what
it's
does
a
that mean?
trade-off. Investments are all based on trade-off, and the bond market is the clearest way to show trade-offs. And so essentially you have to then, as the government, issue it at a rate to attract investors to then buy your bonds. And so in the printing money episode, when we were arguing about you can just print money, I'm saying, no, you can't, because you have to have a buyer, which means they're going to dictate your interest rate based on all their other options out there. And so like we used to be able to issue bonds at 1%, and they go crazy and buy it. Now it's at 4.35%. It was at 4.5% to begin the year. So American rates have been coming down. So then they create that rate, that note, they send it to the bond market. Investment capital then goes to the government, to the...
So sorry, back up a little bit. So is who is determining when and why to make these bonds? That's the Fed?
That's the Treasury.
The Treasury.
Yes.
Okay.
Based on our spending mandates, based on our budget.
Okay, so their goal of issuing a bond is to bring in more cash right now to go spend, and they're assuming they can arbitrage this and do better use of that money now and pay back this interest rate over time. The government is paying back this. The Treasury is paying back this bond?
Yes,
These
correct.
monthly
The
dividends?
U.S. government is paying it back through the
Okay.
Treasury. So the Treasury is the entity acting on behalf of the government.
And what's the relationship between the Fed and the Treasury?
Banks. It's all a banking and a borrower, right? And so here's what happens is the Treasury issues bonds to the bond market, the private market, which is the bond market, and then the Fed is part of that as well. They buy the bonds.
The Fed is a buyer within the bond market
Yes.
and seller?
Yes.
Okay, so
We'll
they're...
they're the biggest player. They're the manipulator. So let's take that out of the conversation for a second. But think of it as there's a private market that exists, and they want to buy debt. There's a lot of equity out there, and they want to own debt. Really good debt, American debt. And America needs to fund via debt. So that's how we create money. So we print some money, we print notes that say in 10 years, we're going to pay you back
this coupon price.
this coupon. Yep. 4.35%. We're going to make quarterly interest payments over the 10-year period of time. And then when 10 years is up, we're going to pay you
That
the maturity.
$1,000.
That $1,000 is coming back.
And that $1,000 stays the same, correct?
Correct.
And so
Yep.
is the difference because these bonds are bought by someone and then they're retraded later on, and that's how the prices swing? Or
Yes, correct. Exactly. So there's an active bond market day to day, every day. But we're not always a government supplying that bond activity, right? So we supply bond activity on regular recurring basis, but the activity is always trading, and that's why the yields are always going up and down.
So is the 10-year Treasury just the bonds they are issuing today and the rate they are issuing them at? when we talk like 10-year yield, like what is this thing?
That's just the maturity date for that note
that they're issuing today.
Correct. So dollars, right?
Okay.
So that all that bond is a bunch of American dollars.
Mm-hmm.
And they are saying to the bond market, we created all these promissory notes because the dollar is a promissory note between America and the bond market. That's what it is. And then we transact based on that promise. America will pay the bond market back. And so they say to the bond market, hey, we're issuing these 10-year notes at 4.35%. You go bid on them, and you're either going to pay us more than $1,000 for that $1,000, or you're going to pay us less based on where you want that yield to go.
The government collects. They potentially sell their bonds for a discount from the that'd be the treasury selling the bonds.
Correct.
They sell them at a discount if there's not enough buyers.
They don't want to, right? So that's where they have to issue it at an interest rate that makes sense to the bond market.
So right now, what we just saw was the 10-year treasury went from, and so I fully understand. So the 10-year treasury is the treasury selling this bond today to the bond market. This is the rate they're paying for $1,000.
Here's a really easy math. Right now, just say the 10 years at 4%. Mm-hmm. So if the government issued a bunch of 10-year debt at 2%, that's the coupon rate, saying you get a 2% yield, well, they're going to get 50 cents on the dollar.
So your bond price would double in that case.
Yes. No, it would be cut in half.
Cut in half.
Yeah,
because,
to get the 4% yield. Because the bond market's saying we want a 4% yield.
Yes.
So if you issue at half that, we're going to give you half of the dollar, right? So we're going to give you 50 cents for every dollar. If they issue it at 8%, they're going to get $2 for every dollar. Because the market says we will transact at 4%.
Yes. Okay. So today we just saw, or recently we've seen the bond market decrease. The 10-year treasury, the interest rate has decreased. So does that mean the interest rate decreased because there's more buyers for these treasuries, so now they can pay a lower rate?
Yes.
Is the idea?
Yeah. And the really good way to think of that is the yield is the reconciled market value of supply and demand. Right. And so the yield can come down for two reasons. One, there's more demand and yield stays the same. Or two, there's less supply and demand stays the same. What we've seen is actually record supply
of bonds.
So
we're issuing tons of debt right now.
Because we're issuing tons of debt. So we see records amount of debt, supply hitting the bond market, yet demand has come up to the point where yields have gone down. So let's now go back 1 year earlier. So last year, bond yields right now are approaching 5%. We were talking about 8% mortgages. I don't know why I'm going this route. So it is a period of time as we are supplying more debt, but demand wasn't there to buy it.
So when the 10-year yield was going up, what was the highest it reached over the past couple of years?
We got like 5.01 or 5.1 for like a day.
So is there a ton of money that floods in at that point? Because
money's coming out. So the problem is demand is going away.
Why is demand going out? Wouldn't you think it would reallocate back in if?
Yeah. So the higher the yield the yield goes up to try and get demand back in.
But people still weren't buying for whatever reason. So So the problem is interest rates have been high. Well, we'll dive into this next. How interest rates in the 10-year are correlated.
Well, we can go to the yield curve. So when we say an inverted,
real quick.
Okay.
I'm trying to think through it still. So the 10-year over the last few years has remained high because no one has wanted to buy these bonds, essentially.
Yeah, because it's hard to. What's your inflation adjusted return?
Okay, so it didn't make sense for people to buy bonds.
Correct.
So, but it made sense for them to buy it years prior. Because what was the 10-year at before COVID?
Less than 1%.
And it made sense at that point, but it didn't make sense 2 years later.
And because there's a whole capital gains investing strategy there as well. That is another byproduct. And a good the good way to explain all this, you go to the yield curve. So the inverted yield curve means that you have less demand for short-term bonds than you do for long-term bonds. So the yield on the short-term bonds is higher than the yield on the long-term bonds.
And that doesn't make sense because you would think you have to get a higher return. You have to park your money longer.
Well,
because everyone would just buy short-term.
So think of it as an allocation. Don't think of about it as yield. Now think about it as allocation, right? So when that happens, it's saying that investment money is on the sidelines because it's nervous for the next 2 years. So that's why the yield has to go higher for the 1 and 2 year periods of time to get that money back into the bond market. Because that's money saying, I'm really not, I don't like this. I want to get out of the bond market. So then, but sellers need to sell. So they're like, well, we'll offer this. We'll offer this. We'll cut our price. We'll cut our price. And then the money's like, oh, well, that yield is high enough for me to get back in.
Okay.
And that's how supply and demand works, is if demand is leaving, you have to cut prices to get it back in.
So does the Treasury care after they sell the bond the first time what happens after that?
Not exactly like with that pile of money, because that's done, right? It's already financed.
They've collected all their money.
They've collected their money. Now they go spend it. They do need to be concerned how they're issuing debt, though, because how they issue debt today based on demand leads to future rates and future borrowing. So you don't want to think of your debt in a vacuum.
Because they could satate the market and not,
Exactly.
and no one could want these future ones if they offer.
Yep.
Too
And
good or
when
too
people
poor.
complain about printing money, what they innately are saying that they don't actually understand is our borrowing rates are going to go up because we're issuing too much debt.
So our borrowing rates are going to go up because we're issuing too much debt. That means there's so many bonds out there that to get money in, they have to increase.
We're
the rates.
oversupplying the market based on the amount of demand that is in there.
So you have to increase rates to get more demand.
Back in. And this is where people don't get it. And this is why it's kind of a Chicken Little complaint, is printing money only matters relative to the demand out there to buy it. Well, we have a bank in the Fed that can just turn it on and turn it off when they want to buy
So
it.
the Fed can buy the bonds as well. So if no one else is buying, they can come in and buy it. So how do they have money to buy?
Because they're so bank reserves, right? So A, they're a bank, they have capital. B, they are the central bank, so the banks are forced to have reserves. So now what does a bank do when they have deposits?
Are they keeping it with the Fed?
Yeah. So when the bank's reserves are deposited.
You're talking about like our local bank.
Yes. Our local bank has a mandate to have a certain amount of deposits at the Fed.
Okay.
Right? That's their reserves.
Typically 10%.
Correct.
Right?
Yeah. And then they manipulate that number based on how much money they want in and out of the economy. But that's deposited at the Fed. Well, what's the Fed? The Fed's just a bank.
So the Fed uses this
Those
reserves to
buy bonds.
Oh, so they can manipulate
Yes.
by the reserve ratio, they can manipulate how many
Exactly.
bonds they buy,
Yep.
affecting the bond market.
Correct. And the other thing is, if you lower banking reserves, well, now our local banks have more money to do what?
To lend
And buy bonds.
and buy bonds also. So wouldn't they want to increase the reserve ratio for this? So they increase the reserve ratio for the Fed to buy more bonds, but they decrease the reserve ratio for local banks to buy more bonds?
Yeah, but the bond, so and this is where it gets really confusing, because the Fed doesn't work just off of deposits. That there's the reverse repo market, so they'll leverage their own bonds to buy more bonds, and that's where it gets really scary and really cyclical, is because now you're stacking. That's where the funny money portion comes in. Like, for those that watch The Big Short, and they call them, what are the synthetics or whatever the word they made for the packaged bonds on top of bonds.
It's like, is it like derivatives or no?
No,
Derivatives are
derivatives is
trading
more like a bet on an activity.
Yeah.
So the Fed gets really complicated in how it acts. But if we just, at the ultimate level, think there's three pools of buckets. There's cash, so there's sideline money, there's debt, and there's equity. And money just moves out of those buckets.
There's cash, debt, and equity. Wouldn't the cash be equity or no?
Equity is invested cash.
Oh, okay, like in stocks.
Yeah.
Okay.
Yeah.
And then debts is bonds.
Yep.
Okay, interesting. Do you know what's the dollar amount of bonds that are issued? Do you know that?
Yeah, well, correct. Yeah, that's, so like we're doing Q4, what do they call it? The resupply, the refunding. And then it's where they're issuing this amount of debt in this amount of buckets. And I don't get into the details of that because I don't care, right? Like, that's just a brain power level I don't want to try and function at. I just want to watch the end result. So that's why I watch the yields, because the yields are the reconciled value of what's happening at the auctions.
I'm trying to grasp, though, how much money this is that we're talking about.
Billions.
From the Treasury.
Yeah.
Can anyone else issue bonds or just
yeah?
the
So
Treasury?
a bond is a
because there's
general
corporate
word for,
bonds
yeah,
also,
exactly.
right?
So there's municipal bonds, there's corporate bonds, so there's junk bonds, there's AAA recreated. So junk bond is just not AAA rated corporate debt.
And that just means the A, B, whatever rating is just like odds that they pay you back.
Exactly, right? Okay. And so if you want to buy debt, you want to buy debt that the the person that's going to pay you back is high credit rating. So that's AAA.
Or take a higher rate.
Or take a higher rate. So then they're not great borrowers, then they're junk bonds. So you just get a higher rate for the junk bonds. So there's a yield curve on all those bonds. And then there's mortgage bonds, right? And so the money, so then at the macro money, it's...
Sorry, is it called a treasury bond, or what's
Yes, correct.
It's called, okay.
And so if you've got equities, cash, and bonds, then the bonds gets broken down. And that's kind of where then the allocation of bond money then creates that yield curve.
So in that book I was reading, it was kind of interesting. It was, and this was kind of shocking to me. So the dollar amount in the bond market is like 5 to 10 times larger than the stock market, which is...
And this is where...
makes the stock market seem really small and insignificant.
One thing that, I saw a video of Larry Fink's comments in front of the World Economic Forum a couple months ago. And his comment was essentially, we've changed from a credit economy to an equity economy. And that makes sense given where we're at. So we used to just be, everything was based on debt creation, debt creation, debt creation, debt creation. Well, we've been doing that for 100 years now. And so what you've created a lot of debt, we've had a lot of government debt and a lot of government deficit. And so that's created a lot of profits, AKA a lot of equity into the private markets. And so now our credit that used to essentially trickle down from the government, because the government started the credit to get it into the banks to then create loans. Well, now that comes from equity markets. So it comes from the government.
How does it come from equity markets?
Because there's just so much equity that's been made over the past 10 decades. So the private individuals have gotten so rich, and that money's been allocated into the stock market, into funds, into BlackRock, right? BlackRock just represents our 401ks. So as we've gotten wealthier as a nation, as we've found other ways to pool capital, all that is equity. And so our markets are based on where that equity is moving to at any given point in time.
Okay. I think I follow that.
Yeah.
Okay.
And so when I look at the economy, I just look at from a mechanical standpoint, where's money getting allocated? And that's the trend.
So do you know the total dollar amount though of this, like of treasury bonds and the total bond? Okay.
No.
But is that true that
It's
it is
trillions.
like 5 times bigger than the
trillion.
stock market?
Yeah.
It is a lot larger.
It doesn't surprise me. Yeah, we're talking. So any given auction is billions of dollars.
Yeah.
The overall stock market, I mean, what's above trillions? It's got to be close to that.
So how do you actually buy a bond? There's like, you log on
Lots
to
of different
Fidelity
ways.
or
Yeah,
Vanguard and you can go buy, can you buy city bonds like through that and state
Yeah,
bonds?
you can buy. So like, I'm not an expert in buying stuff. The only time I got into the stock market, I had a stock trader. And we were buying municipal bonds through this. Like, I don't know the actual mechanisms. So I'm not going to actually try and speak on that because I don't buy that stuff. Wish I did, though, because I make pretty good bond market calls. But you can through either ETFs or some type of fund, or you can actually buy the notes themselves, the short-term notes. You can buy those notes, I believe. I couldn't tell you exactly, though.
Okay. So most of the bond market is affected by these large 401ks and large amounts of money. Are people
insurance money?
Are people day trading bonds and frequently?
For sure. Yeah.
Interesting. Okay, so how does this relate to interest rates?
So if you think of it this way, the reason we have low interest is because we have significant amounts of equity, and so. When
you say equity again, you mean money in the stock market?
Everywhere.
Okay.
Real estate, stock market, gold, crypto.
Okay.
There's a lot of private capital out there, and what does capital need? It needs a yield. And so the words I used for the past decade was low yield environment, low yield environment, low yield environment. Low yield environment is essentially saying we've gone from a credit market to an equity market. We have all this equity in the world, and it needs to go somewhere to get a yield. Does that make sense?
Sure.
And so then, what happened to interest rates and cap rates, right? So, we have all this equity and the American government's doing pretty good and we know they're going to pay us back. So let's go buy some bonds. And so then that lowers the entire yield curve. And so then based on spreads, and there's more equity in the mortgage bond markets, so then spreads go down. And so now interest rates go down across the board. Well, as interest rates go down across the board, you need less equity in real estate to get those real estate transactions. So then you buy more real estate. So then real estate transaction volume increases.
Okay.
So and that's where you get that kind of double dip effect.
Okay. I don't think I follow you fully. So I have a couple questions there. So first one, I was going to write it down.
No, that's good. I'm
Okay.
glad you're doing a good job.
So
Almost out of my brain.
right now, because interest rates are so high, and you're mentioning there's like the bonds for housing debt.
Yeah.
Is there a lot of money flooding to that right now because people see
No.
all-time highs?
Yeah, so right now the Fed's not buying mortgage-backed securities. They're a net seller to mortgage-backed securities. So mortgage spreads go up, right? Because there's less demand in that market. So that means to get demand into that market, you have to increase your yield. And then that yield's going to be based on, well, how much higher is it than the 10-year? So if we're already nervous to buy the 10-year, and it takes us to 4.5%, 5% yield just to get money to go into the 10-year, well, then what's the yield need to be to get money to go into the mortgage bond market?
So is someone that buys a mortgage bond, are they, and the rate's at 7% today, are they collecting a 7% yield actually on this thing, or is there some sort of spread in there that they don't get that full amount? Or are they truly buying this package of debts?
Yes, they're truly buying a package of debts, and they're truly getting the net yield on that package of debts.
Okay.
But when we say mortgage spreads, they're only buying that package if it's 2.5% higher than the 10-year yield. Otherwise, they'll buy the 10-year yield.
To that.
Exactly. So
I
mortgage spreads aren't meaning there's an actual spread. It means that's the trade-off. We're going to allocate money based on a trade-off.
So when people talk about, because commonly it's said that there's 200 bips or so, 150 to 300 bips between our interest rates and the 10-year treasury.
Yes.
That's because people will not buy those unless there is that spread, because one's a AAA and one's a some lower rating.
Yes. And this is a great segue to how the Fed affects interest rates. And so when the spreads were down to 1.5%, well,
on the 10-year treasury,
on the mortgage spread.
Sorry,
So the spread of the 30-year mortgage over the 10-year treasury, right?
Okay.
So right before COVID, that was down to like 1.5%. Well, because the Fed was having so much activity in that, they were buying so many mortgage bonds that there was a lot of demand in the mortgage bond market that the spread did not need to be that high. And that's where now as investors you look at, well, if the Fed's a buyer, there's a capital gains play.
Wait, repeat that. So the Fed was buying a bunch of mortgage-backed securities, lowering the spread there because how are those?
Because again, you're only issuing so many mortgages,
Mm-hmm.
right? So supply is what supply is, and now the Fed comes in and says,
And they're a big player, so
we're a big player. We're buying billions and billions of bonds. Okay. And so then as a lender, you're like, oh, great, we have a buyer. We can go create bond packages, and we have a buyer. But now you're increasing mortgage volume.
So who's the lender creating that on the front end? That's just a normal bank, correct?
Yeah, correct. Yep.
Or private individuals.
Yeah, so you have mortgage brokers, right? So they create loans and they sell the loans, right? So when your local mortgage company says we're selling your loan, well, or they're brokering their loan, right? So a broker brokers a big bank's product to you, and then it's already going to be packaged up. But like a local bank, like an independent lender or like a mortgage bank, they're creating loans and then they're packaging those and then selling them to an actual investor.
So is that Fannie and Freddie are buyers, correct?
Correct. Fannie and Freddie are the biggest player in the secondary market. And it's Freddie and Fannie are the ones that put a ceiling on what that spread's going to be. So in a great way so the Fed pre-COVID, the Fed was buying a lot of mortgage-backed securities. And so the spread was really low. And they were also buying the 10-year yield or the 10-year. So the 10-year yield was really low. So mortgage rates were really low. Now, take that back to just a year ago, the height of interest rates. Well, the Fed wasn't buying. They're a net seller in the 10-year yield, so the 10-year yield goes up. They're a net seller in the mortgage security market, so the spread goes up. So the spread goes from 1.5 to 3 because the Fed isn't involved.
Why was the Fed selling?
Because that was their way of reducing their balance sheet.
Okay.
Yeah. So essentially the interest rates don't matter. It's their bond activity that matters because the bond activity manipulates interest rates, right? The overnight rate doesn't matter. That is a headline. That is a policy direction standpoint. So that only matters to starting a trend or beginning a trend. What really matters is what are they doing in the bond market, because that's what sets interest rates. And so what's really interesting about the 10-year going under 4 today, and not just under 4 but down to 3.8, they're doing this without the Fed stepping in to increase demand. So this is literally the bond market on its own, independent of the Fed, saying we are good with sub 4% yields.
So let's dive into that a little more. So the Fed was not they were not buying more, you're saying?
Correct.
And other buyers, pension, whatever funds over here were buying more.
Yep.
And now the Fed or the Treasury sees that, so they lower the interest rate they're offering.
Exactly.
On
Yes.
current current new 10-year Treasury.
Correct. So the U.S. government right now is the happiest person because they've been issuing 10-year debt at 4.35%. Today they can cut that in.
So now they're borrowing at a lower rate.
Now they're borrowing at 3.8%. So when they issue a 10% debt in Q3 or 10-year debt in Q3, they'll issue it at 4% instead of 4.35%.
Are they issuing it at a quarter at a time, or is this issuing it daily?
Quarterly. No.
So why does the 10-year Treasury fluctuate daily?
Because the private market that holds those bonds buys and sells them.
It's showing the active trading.
Yes.
Oh, interesting. Can it accurately track all the bonds being
Yeah,
traded
and I don't know how all that stuff works.
Okay.
And this is where, like I made a Facebook post today talking about exactly that, changing from a credit market to an equity market. And I think what happens today shows exactly that, because we kind of had both markets were pumped up midweek based on, okay, policy's done, we're going another direction, everyone's happy, money came out of the sidelines into both equity and debt. And then we had the weak jobs report, and all of a sudden, like, oh shit, recession's here, stock market drops, okay? Money gets pulled out of the stock market, goes into the bond market to safety. So we flee from equity into safety, and then those yields go down.
Because there's more buyers, yeah.
Yeah.
So explain, you mentioned a thing a couple minutes ago, the double dip and what happened going into COVID and how that all went on. Explain that again?
Yeah, so for real estate, there's a double dip because because we have the mortgage spread and we have the index. Let's call the 10-year yield an index.
I have a quick question before that, sorry. So the mortgage spread, that's not like a set rate that's happening. That's just people are buying these two separate things and we're trying to correlate them and how the difference between.
Exactly.
Okay.
The spread is a report that's saying that's the difference between what's happening in the mortgage market and the bond market.
So we're doing a loan at 7.25% right now on a commercial loan. It's on some storage complex, and that seems really high to me because we just closed a loan at 6 on something else. So they're just taking a fat spread on what they're...
Yeah, and that's one where you just delay closing, get out of your loan, and go reapply for it. And this is what's really weird is how lenders move. So we've got a DSCR loan that's maturing and we need to refinance it. So I went out to my 3 favorite lenders, 725, 715, 665.
Yeah.
Where did that 665 came from? And this was, I sent the email on Monday or Tuesday. That was just, that lender was more of an institutional lender that was kind of looking ahead and figured this is what was going to happen. We got a text from Gabe today. He just got a 4.99 offer.
Something like that, yeah.
Yeah, so a 5% offer on a commercial debt for 7 years, right? So now here's how lenders are like, oh, guess what? Because lenders need a lend to make money.
So now they have to compete against each other. So once one person starts...
Yeah, really what it is it's like, hey, we can now go get cheaper money, which means we can offer a cheaper rate so we can go lend.
Yeah, so when the bank does that and they're collecting this spread, are they collecting the monthly payment spread on this debt that they
If they're servicing it, yeah. So it comes down to servicing, right? So the loan's made off of points and fees.
So this is a bond that they are trading now that they create, and then they trade it at different prices. So they may issue a $2 million debt and collect 2.3 for it, right? And then just trade it at a different rate. You said it was rates that change or the bond price that changes?
The price changes and the yield. So the interest rate stays the same. That's a fixed rate in the loan.
Okay.
So the yield changes based on what you pay for that debt.
Okay.
Yeah. So if you pay $1 for $1, the interest rate is the yield.
Yes. And then it changes based on the price.
Right.
Yes. Okay. So yes, I follow.
Yeah.
So, sorry, I cut you off. So they create this spread, they're servicing it or selling the full thing at a different price and trying to manipulate them. So them creating, maybe they're borrowing at 4% today, or they're borrowing at the 10-year Treasury possibly, right?
Mm-hmm.
Issuing us a 10-year note. They're issuing they're getting a 4% debt, selling it to us at 7.25. Now they could either collect that spread or they can go sell this bond, this debt that they created, at a higher price than the issuance amount.
Yeah, except it works opposite of that because
Okay.
it's debt. So like right after April 2022, what happened was some lenders started going under because they were issuing debt at 4% and they couldn't sell it because now the bond market expected 5%. Does that make sense? And now you're stuck with a loan that you
Because
can't
the
sell.
bond market, to get that yield, would have had to buy it at a lower
Yeah.
price.
Exactly. So you
So they
either
can't get
hold
rid of
on to the debt and you
Okay.
serve it yourself and you get a yield, or you sell it at a discount, take a loss to get liquidity to go make another loan.
I see. Okay. So going back to this double dip thing, explain to me what happened, who was buying what,
Yep.
and how all this worked going
Yeah,
in.
so November 2021, the Fed came out and said, here's what we're going to do. We're going to, in March, we're going to start increasing interest rates in March, and we're going to start reducing our balance sheet.
So when they say, the Fed says we're going to increase interest rates, that's the
The
overnight
the
rate.
overnight Fed rate.
Okay.
Yeah. So they're going to come off zero, and they needed to get to a restrictive policy. So they're saying, we don't know exactly where we're going to go, but we're going to start a policy change to slow down our economy.
So that means banks can lend less because they can't move this money as quickly between each other? Or-
Nah, it's not that. So the interest rate change had nothing to do with it.
Okay.
Okay. That just says that's indicating to the markets we're now changing our policy to now hurt the economy instead of help the economy. For 20 years, we've been helping the economy. Now we're going to come off. We're going to hurt the economy. That's what they're saying. And we get fixated on interest rates, but the important part is we're going to reduce our balance sheet. We're going to start reducing it by $100 billion.
So the big thing
month.
is that they're buying and selling the
Yes.
bonds.
So
Okay.
they're buying. So the Fed is always a buyer and always a seller in the bond market. So that's where we get the yields that change throughout the day. Well, there's that activities happening. And so when they say we're going to reduce our balance sheet by $105 billion a month, it says they're going to be selling $105 billion a month more than they are buying. And so then that's supplying an extra $105 billion a month to all the private buyers of bonds.
Okay. So they did this in March
2022.
They announced that they were going to
Correct.
be selling all.
And they did it for mortgage-backed securities and for government debt. And
So treasuries and MBS.
correct.
Okay.
And so now the biggest player, the biggest amount of demand, the biggest amount of capital in both of those markets comes out of the market.
Okay. They're selling all this stuff.
Yep. So now you have a shift. There was more demand than supply, keeping rates low.
There, prior to this, there was
Correct.
more demand. than
Yes.
supply.
correct.
Okay.
So February 2022, we had way more demand than we did have supply. April 2022, it
Wait, I
flipped.
thought we were talking back to 2021.
It all started November 21. They said we're going to do this March 22. They
Okay,
told
okay.
the markets.
Oh, and
This
then they
is-
started pricing it in early.
No,
Or-
no. This is
Okay.
this is what's so funny about banks and how stupid they are. In November 21, the
Okay.
Fed told every bank out there. So our unrealized loss discussion that I said was no big deal that everyone
Mhm.
complained about a year ago. 4 months prior to all those unreal losses, the Fed said, "You're all you banks holding all of the debt. You're going to have unrealized losses because the value of your bonds are now going to go down
Because we're selling so many.
because we're selling so many." So
Okay.
in February 2022, because the Fed was a buyer, a net buyer, there was more demand than supply in the bond market. Only 2 months after that, in April 2022, it flip-flopped because the Fed changed their bond policy, their balance sheet policy. Overnight, we had more supply than we had demand.
And they said they were going to do this in 2021.
Correct.
And it takes effect in 2022.
Correct.
What's the difference between, they said they were going to do it sometime in 2021,
Yep.
but they're going to start doing this in March
Yep.
2022.
Yep.
But then they changed what they were doing in April, you're saying?
No, I'm just saying that that's the event. So it started in March. So the
Okay.
difference between February and April is drastic.
Okay.
Because of one change, because of their monetary policy change. We get focused on interest rates that does almost nothing, and we ignore the biggest thing they did, which was change their balance sheet operations.
Okay. So they started selling all these, and that's when rates started to go up.
Correct.
But what made, let's step back prior to that. Why were rates so low prior?
Because of the massive amount of money that was in the bond market and the mortgage-backed security market, which came from the Fed. The main player in all those markets in the bond buying market was the Fed. We were buying our own debt
Okay. So and they had been doing that because rates had been
since
super low.
2008.
Yeah. So they had been
Yep.
trying to stabilize the economy.
Yep. So
By
think of
buying
it
all
this
this
way. before the Great Recession, the Fed balance sheet was just under $1 trillion. After COVID, it was over $9 trillion. So between 2008
In assets,
and 16
liabilities,
years,
what are you saying?
that's their balance sheet is the total aggregate of their assets and liabilities.
Yeah.
And so that grew by $9 trillion in 16 years.
Wait. Explain, because I understand how a basic balance sheet
Yeah.
works, but I'm trying to grasp this. I'm not grasping it. Explain, like, if they have $1 trillion on their balance sheet,
Yeah.
you mean
That's their net worth. The easiest way
Yes.
to
So
they have $1 trillion of net worth. And then that net worth they have to invest it.
Yeah.
And the Fed only invests by lending. So that means in 2008, the Fed had $1 trillion in the lending markets.
Yeah, because their debt they issue is their asset.
Correct.
Okay.
So the debt they own is their asset,
Yeah.
right? So then fast forward 16 years, their balance sheet is now $9 trillion of the assets they own. So that means there's $8 trillion million more in the lending markets
How does that happen?
through government creation and profits being made and changing reserves. And so as GDP increases, our overall economy increases. And so more wealth is created, more wealth is stored, more wealth is banked. And then the other thing
So
is,
are they just arbitraging bank money, local bank money, and then they're investing that essentially?
and they have their own money. And the biggest component of all of this is the government issues debt. They sell it to the bond market, which means they printed a piece of paper. They turn that paper into cash, and then they deposit that cash at the Fed until they spend it. So what do banks do with deposits?
Wait, repeat that one more time for me.
So the government creates promissory notes.
Yep, through the Treasury.
Through the
they create
Treasury.
promissory notes.
They give it to the bond market. The bond market gives
Okay.
them cash. They trade the notes for the cash.
And
well,
then
it's going to take them years to spend that cash. What do they do with it in the meantime?
Do they give it to the Fed?
They deposit it at the Fed.
Oh.
And so now the Fed has our banks' deposits at the Fed. The Fed has our government deposits at the Fed.
Oh, wow.
The Fed has all of their own money. Remember, the Fed was created.
Would they even have any of their? How do they have money to start?
The Fed was created by the 5 wealthiest people, banks, in 1913. They've just gotten wealthier. So
The Fed was created by private individuals?
Yeah,
Like private banks?
J.P. Morgan Chase
Created the
and
Fed.
Rothschild.
Oh.
Yeah, those guys, those players, the oil guy, like all those guys, they controlled everything, and they then consolidated it into a private bank that is not in cahoots with, but it runs step in step with the government. And this
Isn't the Fed, because the Fed is the government's bank, but the Fed is regulated by the government, no? Like, what's the...
the Fed is regulated by monetary policy, so they're mandates.
Okay, but the Fed is a private bank.
Mhm.
Oh.
Yeah, it's correct. And they have, so it's 12 banks. The Fed is 12 banks, 12 regional banks, and then there's a president in each bank. And then there's the FOMC, the Fair Open Market Committee. So of all the managers, the governors, and presidents, there's a committee, I think, of 12 people or 19 people or whatever it is, their committee. And then they have tenure on that committee, and the committee votes. So those 12 to 19, I can't remember what it is, 12 or 19, their opinions are reconciled into a vote, which then leads to policy. And so that's where, like, the dot plot matters, because the dot plot is showing us where those individual opinions are showing up in the future.
So if they're a private bank, how does their decisions over here become policy? Like, what government branch takes this opinion over here of this private bank and makes it
Well, they're
policy?
doing only Fair Open Market Committee decisions. All they're doing is saying, this is the amount of money this is our
Oh, it becomes
bond
policy
activity.
for that bank.
Their policy is essentially bond market activity and interest rate activity, and then all their loan facilities in between.
That's crazy.
Yeah, so they're just a bank. The Fed is just a bank, but
Yeah.
they're the bank that says we're going to do this and we're going to do that. And they're so big that what they say matters.
Do credit
in the
unions
bond
borrow from the Fed?
The Fed, think of it this way, like, remember when the PPP loans and the EIDL loans came out?
Mhm.
Well, those were done by SBA lenders. So the loans were created and funded at the local level by local banks, and then they were just sold to the Fed.
Why would the Fed buy those? Because those are forgiven. Like, this seems...
Because that's part of that. So this is where fiscal policy and monetary policy meet, right? So from a fiscal policy standpoint, we said we need to create these type of loans, and the Fed's gonna facilitate it.
They're
So-
just taking the loss
The government's ultimately taking the loss.
because they sell it again to the government, or
They'll get reimbursed. I don't know how the activities work.
it's backed.
But essentially,
Okay.
the underwriting and the loan has to get funded at the local level, and then that local bank needs to get reimbursed from the Fed. So they sell that loan to the Fed,
Okay.
and then the Fed's gonna service that loan that period of time, and any loss they then get from the government because the government created the spending package for these loans.
Okay.
Does that make sense?
Who prints money? Which
The government is.
yeah,
the
but
ones
is
that
the
print money.
Treasury prints the money
Yes,
actually, or
correct.
does somewhere else print it and then the Treasury?
Yeah, the Treasury is the printing operation.
Okay.
So the Treasury is the checkbook essentially for fiscal policy decisions.
Okay. So when you have some of these loans are government backed, like FHA, right? So
Yep.
when someone buys those, it's backed by the government. That means if no one pays on that, the government
Correct.
is guaranteeing that they will pay it. Is
Yep.
that the Treasury guaranteeing that?
It's HUD. So HUD is funded through
Okay.
fiscal policy.
And then there's grants and
Yep.
tax dollars that go there, whatever, they're guaranteeing it.
Exactly.
Okay. Okay. So going back to 2020 to 2022, it's
Yep.
So because for the 2008 to 2020-ish, they are a net buyer of bonds. It keeps rates really low. And then they switch, which changes rates. And they switched because of COVID. And why did
Yeah.
they were trying to affect
So-
how the economy was working?
Yeah. So think of COVID as the Fed was a net buyer well before COVID.
Okay.
They were trying to come off of it from 2014 to 2019. They were trying to taper. So we had taper tantrum. And actually what happened prior to COVID is we had an inverted yield curve November of 2019. Emergency meeting by the Fed on a Sunday. Interest rates were at 1% at that time. They were trying to reduce their bond buying activity. They met on a Sunday, put interest rates to 0, and they said one statement: we are going to backstop the bond market. Immediately, inverted yield curve goes away.
So they were going to buy again.
Yeah, because now you take money, macro money, private money, and you give them confidence to get in the markets.
The inverted yield curve, people talk about it all the time.
Yeah.
So that's like, it's happened like what, 11 times or something like that?
Yeah, and it's before every single recession.
Okay, before every recession, an inverted yield curve has happened, but there hasn't been a recession after every inverted yield curve, though, correct?
That, I believe, is correct. Like right now, we have the longest and the deepest inverted yield curve we've ever had.
Or were we not in a recession? I thought we were.
We have a recessionary. Is it defined as a recession? Maybe it'll get defined as a recession later. When will that date start? We'll never know until
Because the definition changed.
Yeah, exactly.
So if you use the same definition that was used, you are in a recession at this point,
Well-
correct? But people are not having the effects like you would in 2008 and other recessions.
Yeah, like there's levels to recessions. Yeah. So recessions, the way I like the definition is jobs are down, incomes are down, productivity is down, inventory creation's down, right? So just everything is slowing down. Well, incomes are up. Unemployment's, like
Because the actual definition is based on GDP, correct?
yeah, two consecutive quarters of negative GDP is what you'll hear. But there's an actual department inside the government that then says whether or not we have a recession, that they do it reversed.
Okay.
Yeah.
So the inverted yield curve, you think we're still going into a recession because we've had this inverted yield curve, or there's one to come still?
Yeah, an inverted yield curve says that the private markets believe a recession is on its way.
So the inverted yield curve means the short-term debts are paying a higher rate
Yes.
than the long-term.
Because money doesn't want to be in short-term debt because it wants to be ready to pounce after a recession.
So, and that's just because those debts were issued many years ago, and now they're not trading actively, is how those are.
They're
affected.
trading actively. There's less
Less.
demand for the sellers.
So now the people trying to exit those things coming due to their balloon.
Yeah.
It's what's it called at the end of their
Maturity date.
maturity date?
Yeah.
So these bonds are coming to their maturity date within 2 years. So now they're selling at higher yield,
Yeah, lower prices, higher
lower
yields.
prices, higher yields.
Yeah. So like a banking crisis comes from the event of we ran out of deposits. Now people are leaving, and the only way to stay solvent is to sell our bonds. But our bonds, the value are cut in half.
So now we're taking losses
Yeah, and the way their balance sheet shows, they don't show unrealized losses
right now.
right now.
So that they don't actively price in the proper
Correct. the
price of
value.
bonds.
The market value of the bonds is
So
not
they're just
reflected
looking at
on-
what they
yeah.
bought them for,
Correct.
probably.
And that's why the Silicon Valley happened, was because you had a lot of smart depositors look at their balance sheet and go, these bonds are worthless. You grew your balance sheet 4x in 2 years, all based off bond purchases, and that's a deck of cards that's fallen. And so then their depositors started taking money out of their bank, and they couldn't sell the bonds.
But is it because the government's backing those bonds, are they not? So then if it
Yeah,
comes
but-
due, you get paid out the actual dollar.
Yeah, so if you can get to the maturity date, you're fine. The problem, you don't have an unrealized loss if you get to the maturity date. You have an unrealized loss that never becomes a realized loss if you can get to the maturity date. The problem is if you're in a crisis and the maturity date is a year out and you need to sell now, you're taking a huge loss. And so your balance sheet may show that you're okay, but if you had to sell, that balance sheet is now significantly different.
Couldn't you just borrow more?
So that's what the Fed did to solve this problem, was they created a credit facility that said, we're going to give you a dollar for dollar loan based on the bond price that you bought it at.
Yeah.
So that solved all their liquidity, right? So that's why it wasn't a crisis. Why I said from day one, it's not a crisis. The Fed has the exact tools to cure that problem.
Yeah, they can lend you more money backed against their bond that they know they will repay.
Yeah.
So in the case of SVP, like why did something like that not happen?
So the bank went under before the program was created. So that's the biggest problem.
Oh, so it didn't even exist.
Yeah, correct. And then you look at, so 3 banks got affected: First Republic, Silicon Valley, and then the one for Citizens, whatever it was in New York. Well, 2 banks, the Fed and the FDIC, said, nah, we don't care about you. Why? Because they were dumb. They were not a good bank. They were falling. They were beyond insolvent. They weren't savable. First Republic, they actually gave a loan to, because they looked at First Republic and said, we think you're savable. You actually are not making bad decisions. You're just a victim of being in this region where this other bank is failing.
So that's the Fed giving.
That's the
loan.
FDIC. So, the Fed gave, yes, correct. The Fed gave a loan to First Republic Bank.
Yeah.
And during this period of time, you have Janet Yellen, who's the head of the secretary of the fucking U.S. secretary. Can't remember her title. And then you had the FDIC and you had the Fed. So all 3 of them are communicating how we're going to cure this crisis in the period of time.
So what is the FDIC?
So the FDIC is the insurance. So that's the insurance for depositor.
And that's a government insurance, or is that
Yep.
private insurance?
No, it's a federal
Okay.
depositor insurance company.
Okay.
Yeah. And so then you have to say, okay, well, our depositors, can we make depositors whole? So that's the FDIC model. The Fed, is this bank salvageable? Can we give them a loan? And JP, 5 of our Wells, JP, U.S. Bank, Bank of America, they gave First Republic a loan. So the markets, the banking industry essentially said, First Republic, we think you're okay. You're getting affected.
They saw financial gain by giving them the loan.
Yeah, exactly. And at the very end of the day, well, it's just a financial asset, and you're trying to save a bank, and then you can buy it if it goes bad, which is ultimately what happened.
Because they would look at their balance sheet and saw actual value that they
Yeah.
could collateralize the loan against.
Yeah. And the reason it was First Republic that went under is because it was the same depositor profile as Silicon Valley. Same exact depositor profile. High net worth people, uninsured deposits, right? Like Chase doesn't matter because 90% of their deposits are insured. First Republic, Silicon Valley, 10% of their deposits are insured. So that's that flip-flop on why the bank kind of goes under.
Okay.
Yeah.
So going back again, I gotta keep cutting you off. So 2022, the rate, explain that again now.
Yeah. So in March,
Yeah.
the Fed completely changes their bond operations.
Okay.
Instead of pumping money into the bond markets, they're now sucking money out of the bond markets. So now that flip-flops supply and demand. So instead of yields staying low and going lower, like they did during COVID, yields are now going up. But they're not just going up.
So yields going up, prices down.
Yeah. So now, correct. So there's more supply than demand. So prices go down, yields go up in the 10-year. But they're also doing that in the mortgage market, the mortgage bond market. So spreads then are going up in the mortgage market. And so if you have your spreads going from 1 to 2, well, there's a 1% increase just from the spreads. And if you have your yields going from 1 to 5, well, there's your 4%. So there's your 6% increase in interest rates.
Okay.
The numbers were a little bit different. I think it went from 2 to 5. And from 1.5
So
to
because
3
they stopped buying treasuries and mortgage-backed securities.
at the same time.
And so how are those two related again then? Because you're saying it's a double dip. I see why it's a double dip. But
It's
how
the
are those
allocation of
related?
money. So it's okay, as a macro money, do you want ultimate safety, buy a bond and get a 4% yield? Or do you want almost as good safety and buy a mortgage-backed security and get a 6% yield? And so it's just a trade-off.
Oh, and then they're just compared between them. So then
Yep.
the money's allocated. Okay. So both of those increased. So, I see. So both were increasing over
Yep.
time. And then the spread between them was increasing because of the risk
Yep.
profile. And
Yeah. So our think of it this way: our 3% mortgage rates came from a 1.5% 10-year yield and
Yeah.
a 1.5% spread. So that creates a 3% mortgage.
who's buying those? Like, why are people buying those?
The mortgage back?
Yeah, when it's that low. Like,
Yeah.
why is there any
Equity.
demand?
Equity holders.
It's just dollars sitting there and there's nothing
It's
else
just
to do with
movement
it.
of money, right? And so when you're an equity holder, and especially at the banking level, all you're doing is margin. So what you're lending at doesn't matter
Because you're taking
it's
deposits.
it's relative to what you're borrowing at.
Isn't that cause problems though? If you're taking in deposits as a bank, you're buying a 10-year treasury at 1%.
Mhm.
That's really bad to take in money and bank on make a 10-year bet at that time. It seems like.
Yeah, it all relative to your portfolio,
Yeah.
right? So these are just investments that sit inside a portfolio. So it's all relative to their own balance sheet.
Okay. I've learned quite a bit.
Yeah, this has been fun.
Yeah. Do you have more you want to dive into right now? We've been going for an hour.
Yeah. Well, I think so. The greatest way to wrap this up is today is such a historic event because the job going to 4.3% unemployment. And so this is where the Fed matters. So if you go back to their predictions in 2021, when they predicted 2022 off of this policy, I think they said an unemployment rate at the time was like 3.4%. They predicted unemployment to get to 4%. We never got there. And then I think for 2023, they predicted 4.1%. And then for 2024, they predicted 4%. Well, we went in the past two readings, we went from like 3.8 to 4.1 to 4.3. And this is the SOM rule. So the SOM rule is this lady economist who created this rule. And I think I was just listening to an interview. This is all news to me on Bloomberg of her. It sounded like it was a tool she created during COVID to look back over time to try and get fiscal policy to line up with monetary policy. And the rule essentially says when the unemployment rate has gone more than 50 basis points, so 0.5% over the prior 3-month reading, so it's a 3-month trend. So what's that 3-month trend? If it increases by 0.5%, that is indicated every recession since 1970. So it's kind of like the inverted yield curve. If here's a rule, we're getting to this point. And what's different about the SOM rule and the inverted yield curve is the yield curve can be manipulated overnight by one statement from the Fed. Unemployment is a process, right? It took us 20 plus months to go from 3.4 to 4.3. And the reason there's fear and the reason that they're scared is where's that rate of no return, right? So
Can't you affect that overnight too by issuing the PPP loans and all those things? I mean,
yeah, well, you can't. Yeah, and yeah. So can you add? Yeah, so that's the way the Fed would rather break the market because they can add liquidity. It's a lot easier to add liquidity to it than take liquidity from it. And so from their standpoint, they're okay. But the way I think it matters, and the reason it matters is, okay, we hit their indicator. We hit their most important indicator. It's beyond that indicator. They are now going to cut. And my statement on the other day was, I think they're going to cut just because they need a cut, but they have no intentions. So it's cut and then wait for the data. There's no real intentions to cut beyond that because the data isn't.
you're saying cut the overnight rate.
Yeah, just to
But
create.
you're saying that doesn't matter.
Correct.
it
It
kinda
matters
matters.
because it signals a change and the stock markets are emotional and they go crazy. So they've been reluctant to cut because they don't want to signal to the markets and let them go crazy.
I see.
But at some point they have to do it to just get it over with. So my thought was it's September, it's appropriate, cut, get it over with, and then just wait and see where the data goes until today. And then the jobs report came out and unemployment's 4.3%. Now it wouldn't surprise me if they cut 50%, 50 basis points in September. So the same thought
Because
process.
they're trying to lower unemployment.
Yeah.
They're trying to lend money.
So the whole, everyone's been, the knock on the Fed is too late, too late, too late, too late. Well, what if they do a half 50 bips instead of 25? Is it too late? You know, right? Because you're thinking quarter rate cuts over a couple month period of time. Well, they can do that in one meeting. What if they did a 75 basis rate cut?
But again, you're saying it doesn't matter. So why? So if they
It matters because it signals to the market.
Okay, but if they're cutting, you're saying they're cutting the overnight's rate by 50 bips.
Here's why it matters. Because when you signal to the market that this is what we're doing, now money gets reallocated. And so if money gets reallocated into the bond market like we're seeing, debt prices come down across the board. Why are we concerned about the economy? Consumer debt costs are too high. Corporate debt costs are too high. There's already appetite for corporate debt. That has been shown throughout the past 2 years. Well, that appetite hasn't gone away, but because of what's going on in the bond market, they can still have appetite for corporate debt at a lower yield. So corporate debt's going to go down. And so by indicating the change, they move money, which changes interest rates. So it's not what they change only changes the banks and their cost of money, but the movement is what matters because it signals the markets, and that triggers the markets to then move.
I think you broke my brain. I'm gonna have to re-listen to this episode at half
so
speed.
Let's go. So this past week, right? So okay, they're gonna cut in September. Everyone's good. Money comes off the sidelines. Stock markets go up. Bond market goes up. Yields go down. And then a weak job report. Oh shit, recession's here. Money out of the stock market. Stock market takes a huge loss today, goes into the bond market. Bond values go up, yields go down. So that's the allocation of money.
Okay, so why does all this matter? You're trying to predict future interest rates by looking at all this data and whatnot?
Yeah, so interest rates directly lead, so in real estate, interest rates directly yield to affordability, and right now affordability leads to transaction volume. Transaction volume leads to market conditions. And so I want to know when I have leverage as a seller and when I'm losing leverage as a seller, and I want to know when I have leverage as a buyer and losing leverage as a buyer. So like this past 2 to 3 months where people have said, Mike, you're a fucking idiot. The market is not turning. I'm like, it already has. We have turned. We're in it. Volume has stayed low. Why do I have that sentiment? My window as a buyer is closing. I want to buy. My window as a seller is opening. I don't want to be desperate for the stuff I have on my product on the market. Does that make sense?
Yeah.
So like how this plays out is, I had some flips on the market that weren't getting any activity. Feedback is you're overpriced. My feedback to my listing agent is sentiment's low. That is a buyer who is looking to buy in July. He's not my buyer. I don't care what they say. So your feedback doesn't matter to me. I'm going to wait it out. I'm going to wait for sentiment to come back. I know interest rates are coming down. I know people will come back off vacation. So you're going to have artificial demand increase just because people are now looking at real estate again instead of having fun. Combine that with more effective purchasing power because rates are going down. I don't need to lower my price. And I started getting really aggressive and vocal on that on Facebook, and then you get a full price offer. And that's before rates come down. So, that's where I, as a supplier of real estate to the market, want to understand where should and a really good example of this is we have 9 finished units, condo units on the market right now. And our builder partner is getting pretty concerned. We had 6 of them at one project, not getting any showings, any activities, pushing for price reductions. And we've got 3 of them listed. He wants to reduce it on. Like, whoa. You don't want to show the market you're bleeding. I understand we want to get something sold, and I understand sentiment's low, so let's create a strategy that works. And so what we did is we listed another unit at a builder discount. Like, here's a builder special, under $400K, 35 less than the others. The only reason we did that was to increase activity. And guess what? We got one pending. And guess what? Oh, well, we'll extend that to another unit. And then we got another one unit pending. And so now we have less supply to sell, right? So we did it just to get some triggers going. And then, you can have list prices that are higher than your pending prices. Mm-hmm. So you're signaling to the market that there's activity there. You're changing your offering to the market, your level of motivation because, last month we had 0 of 6 units pending. This month we've got 2 of 6 and lots of showings and rates going down. So if I wasn't aware of what was happening here, my conversation with our builder partner would have been significantly different. And so I feel like I've had these multiple conversations with him trying to talk him off a ledge of like, look, if we cut $40,000 on 6 units, that's $250,000 of profit. How about we cut $40,000 on 1 and then $40,000 on 2? let's not go overboard.
Yeah.
Right? Let's get activity. Let's be cognizant of something, but let's not shoot ourselves in the foot. And so I was able to have that confidence because I've watched these market economics happen so much that I can see the patterns and I can recognize the patterns. And so that's why last August, when I say the 10-year yield will not go above 5%, it didn't go above. Like, I can make these statements because it's just pattern. All it is pattern recognition of money allocation. It's as simple as that.
Okay.
Yeah.
Cool. Well, I think that's it. Right now, we were going to dive into midterm rentals, but I don't think we have time.
We kind of ran out of time. I mean, we can. You want to do another one? Are you?
No. I got to do some other stuff today.
All right.
But cool. Thanks, guys, for listening. Hope you guys learned as much as I did. I learned a ton there, so that was cool to get here to sit here and ask questions.
Read the bond book.
I know. Now I'll go read it and understand it better.
Cool.
Dane might listen to this and be yelling at you in the background about some shit because you guys do that a lot.
We love
so
to.
Dane, you can come in and argue whatever you thought Mike
Take
said
notes.
was wrong.
Take notes. Let's go.
But sweet, guys. Thanks for listening. Share this podcast with some of your friends. It helps us out a lot. Have a good one.
Adios.